Hello, I'm Alan Kohler, founder of Eureka Report, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Did you see that Elon Musk and Donald Trump are going at it now? I mean, it's interesting because it's all about from Musk's point of view, it's about the one big beautiful bill that just passed through the Senate last night as well. 51 votes to 50. So, only just, I guess. And now it's got to go back to the House of Representatives to be voted on again. And that's not going to be a lay-down misère either. I mean, a lot of Republicans are against it now.
Yeah, I think it'll get through eventually. And I think that's what Elon Musk is sort of unhappy about. I think there's a couple of interesting things. I mean, it's pretty funny that Trump has threatened to have a look at deporting Elon, or to sick the Doge monster, as he called it, onto right. Elon. I think that's all.
He said the Doge monster will come and eat Elon.
Yeah, which would be a great irony. I mean, no one's got any sympathy for Elon, but he's right. I mean, this is more of the same from the Republicans and Trump, who promised, again, to clean up the swamp and get America's fiscal deficit under control. This bill does nothing of the sort. The other interesting thing is how little markets care. I mean, even, the bond vigilantes, they were supposed to be really exercised about this increase in debt. The bond yields didn't move last night. They're back down to 4.2%. Down from 4.5% a couple of months ago. So, look, I mean, the only thing that's reacting is the US dollar, which just keeps falling. I guess that's a signal of the rest of the world's view on this.
That's also what Donald Trump wants.
He does want that. That's true, yeah.
So that's a good thing from his point of view.
Yeah. I think the other thing, Alan, is investors like to say, they like to pretend they're Warren Buffett and they think long term and all that sort of thing. But a lot of them are like politicians. They can't see beyond the next 12 months or the next electoral cycle. The US government continuing to spend like a drunken sailor, it's good for economic growth. It's good for company profits. It's good for share prices. And, tomorrow's problems are tomorrow's problems. We'll let someone else worry about them. I do find it, investors like to talk about this thing, Ray Dalio talking about the debt bomb and Stanley Druckenmiller always, out there talking about this. But I think the majority of investors, they're happy for the bubble to keep being inflated. I think that's
but it's good for share investors, but it's not supposed to be good for bonds. I mean, what has happened to the bond vigilantes? I mean,
I think they're more focused. They're more focused on what's going to happen with the Fed and rates coming down. It's interesting though. I mean, I guess the bond vigilantes can come and go at various times, but the lack of reaction on the market. This is just another thing that markets have gone, yeah, okay, don't worry about it. I wrote a column last week about this sort of meme going around markets that nothing ever happens, Yeah, okay, everyone's firing missiles at Iran. It'll work itself out. Yeah, okay, there's tariffs. They'll work itself out. And you can sort of see the point of it. It doesn't feel right to me, and I think a lot of this stuff will matter at some point, and it'll matter in a pretty consequential way. But
what are you saying? The point? What is the point that it doesn't matter in the short term? It might matter in the long term.
That's right. I mean, for the point of this sort of mantra of nothing ever matters is just keep buying, because in the end, stocks recover pretty quickly. It's the sort of Victor Schwetz's argument, the strategist from Macquarie, who basically says, there's nobody wants this bubble to deflate. It's not in the interests of government or central banks for the bubble to deflate, so bet on it continuing to inflate. And again, there'll be some break at some stage, and it'll be nasty, but, buying the dip is working.
You actually wrote a piece was it yesterday? I don't know, about just basically saying that it's a bubble or a bubble's building. I mean, the market's back to the share market, the Australian share market's back to all-time highs, basically.
Yeah, I mean, I think there is a bubble building, and I think Trump can stoke a bubble in the second half of this year. That's the argument, by pivoting away from ugly stuff like tariffs and once he's got the big beautiful bill through, he can focus on tax cuts and deregulation and all the the sugar hit that markets have been looking for. And you think about all the things that markets have weathered in the first 6 months of the year. We're now back to the same point we were. And you can argue that you're going to get rates coming down. You're going to get fiscal stimulus in fiscal stimulus in China and Europe and the US. That's pretty bullish for stocks.
That's true. That is true. You had another interesting piece I wanted to just raise with you about SMSFs, and you were quoting Tim Toohey from Yarra Capital.
Yeah.
And he said he calculated that SMSF return for the I can't remember the time period.
Yeah, it's about
was 23%, and there was an 11% difference. That's right. So SMSF returned 23%, and their assets went up by 34%.
That's right. Yeah. So there's an 11% difference there. How's it explained? And Tui went through a few different possible explanations. Are there more younger people in SMSFs? No. Is there more people rolling over from large super funds to SMSFs? There's a few more, but it's not meaningfully different. Is their asset allocation of SMSFs better than super funds? Well, not really, because SMSFs are notorious for holding large amounts of cash. And so what Tui really came down to over this process of elimination is that it's the tax advantages that you get from having an SMSF that explain that 11% difference between
and specifically the tax-free after 60 deal.
Yeah, the zero tax pensions, and then there's some other things that are other tax strategies that people can use that big super funds can't, including residential property, which is I think about 6% of SMSF assets. So Tui's point wasn't that SMSFs are doing anything wrong or that they're bludging on the tax system or anything like that. And in fact, his strong point is that SMSF trustees have played by the rules that have been set for the long term, and they've done exactly what they're supposed to do, exactly what the long-term nature of super suggests they should do. So he's got no problems with that. His point is more that if you think about this Barney over the unrealised capital gains tax introduction, his point is that as this treasurer and future treasurers look for budget savings, he says it's inevitable that super tax concessions, and specifically SMSF tax concessions, become a tempting target for politicians to go after. I've had lots of feedback, Alan.
Have you?
People telling me that the difference, why SMSFs have superior asset growth is their fees are lower than what you would pay in a large super fund. I think that's pretty marginal. And a few people telling me it's because SMSFs are better investors. They're more like Warren Buffett. They don't worry about benchmarks, and a few people telling me that it's about scale. An SMSF requires scale. It really works best when there's $5 million in it. I think that goes to the point as to why they could be tempting for future governments to attack. But as we think about tax reform, which the Treasurer Jim Chalmers says he is, I think these things are going to come into focus, rightly or wrongly. I'm not saying, as I say, I think SMSF trustees have completely played by the rules that have been set for them. But
the point that you and Tui are making is that it's not about their superior return, which is a bit superior to the big super funds, 23% versus 20% return. It's about the difference between the return, the investment return, and the growth in assets, which is 11%, which can only really be explained by tax.
Yeah, yeah.
And so you're right. I mean, so that's, and the other thing that the point that Tui makes, I think, and you make, is that 11% difference is regressive in the sense that if the extra the tax benefit, the tax advantage that SMSFs have is favours rich people, because that's where most of the money is. The people who've got money, that much money in SMSFs, are people who are well off.
Yeah, yeah. So, I mean, I think if you step back from it, the overall point is, if we're going to have a bigger conversation about tax reform, and I know you've talked about inheritance taxes last week, this is another example of where the conversation is going to switch increasingly to wealth. I know we've got a lot of questions about inheritance taxes.
We'll talk about that in the question.
Yeah, yeah. But I think that this is where the conversation's going, isn't it?
Yeah, I think so. Well, yeah. I mean, I actually think that they won't. I mean, Albanese will never do an inheritance tax, even if Chalmers wants to. Albanese won't let him.
Yeah.
So I don't think that's going to happen. In terms of tax reform, I had a piece on Monday saying, quoting Richard Holden, who's the professor at University of New South Wales, and he's got an idea of that you increase the GST, but you make it only apply to spending above $12,000 a year. So in a sense, you introduce a tax-free threshold to GST. So, and I rang him up and said, how could you possibly do that? I mean, how can the government know how much everyone's spending? And his answer was quite simple. You don't worry about that. What you do is you simply give back to everybody in the country the 15% of the GST. He says put the GST up from 10% to 15%, but then you give back the GST on up to $12,000, which is $1,800. So basically, everyone in the country would get a check for $1,800 or have that dropped into their account each year. So basically, you'd get back the money, the GST you'd spent on everything up to $12,000.
And above that, you pay.
That's right. So the GST would therefore only apply to spending above $12,000. So it becomes then a sort of a bit like income tax, which has a tax-free free threshold, and so does GST. I think that's an interesting idea.
It's very creative, yeah.
And it kind of works. I mean, he's modelled it out. I mean, he says putting GST from 10% to 15% would double the GST, and also broadening the base so that you basically start taxing everything instead of leaving stuff out, and that would increase the tax to take from GST from 90 to 100 to 180 billion, so double it, and the giving back the GST on spending up to 12,000 would cost 45 billion, and end up with 45 billion extra, and you could use that to cut income taxes and to reduce or eliminate the deficit.
There you go. Bit of creative thinking.
I think it's interesting. We had house prices the other day, 0.6% national median increase for the month of June, which was the biggest. So house prices have gone up 5 months in a row. Total of just under 3% over that 5 months, and the increases are accelerating.
Yeah. Interesting comment from George Therineau, who's the economist at UBS in Australia. He raised the idea of could we see could the rise in house prices be a problem for the RBA down the track, in that inflation sort of comes back? He says there's a sort of 9-month lag where higher house prices seep into higher construction costs and higher rents. So it could be a problem for the RBA down the track, but I don't know. I think inflation looks pretty well contained at the moment, so maybe the RBA is willing to live with that. Although you look at the recent stuff out of the Council of Financial Regulators, which is the RBA and APRA and ASIC, they are getting worried about household debt levels. So that might be a bit of a watching brief, I guess.
I was at a discussion yesterday, which was Chatham House rule, where you couldn't report anything at the Australian Housing Supply and Affordability Council, which is headed by Susan Lloyd Hurwitz, former CEO of Mirvac.
Yeah,
and there was a lot of discussion about what to do about it, and there was a panel discussion, and really, there's no simple solution. Everyone's kind of thrashing about, what are we going to do about the housing affordability, and there's not really any kind of easy answer.
Well, if there was an easy answer, we would have done it already, right?
That's right.
And I mean, I think there is a lot of thrashing about, but I think in a way the thrashing is good. It's good that people are exercised about this and constantly trying to find, because it'll take there won't be one silver bullet. There'll be lots and lots that we'll need to fire over 10 years. I mean, took 10 years to get into this state. It's going to take 10 years to get out of it. So we've just got to keep working away at it, I reckon.
Yeah. So my challenge to the room was, because everyone in the room was kind of something to do with housing and all that stuff. And I said, well, the thing is, everyone talks about it being a crisis. Is it really a crisis? If it's a crisis, then you do extraordinary things. You would, if you really believed it was a crisis, and and one of the problems was planning, that there's not enough land being released, and that local communities were preventing infill and densification of their suburbs, you would take it off them. You would simply nationalise planning and take it off councils.
Yeah, good.
But nobody's going to do that. I said, and also the other thing is, I mean, do we need this many golf courses, really? and parks, God. And I mean, they were talking about how, in order to achieve the sort of housing that is needed, even to meet the target of 1.2 million over 5 years that the Housing Accord has set, to meet that, they talked about needing, 34 square kilometres of extra housing land released per year. Well, that's a lot of land. I mean, where are they going to get that from? Yeah. This is just to meet the target. They're nowhere near it.
Wow. That's one of those, when you say it like that, it's a lot of, just shows you how much needs to change, doesn't it? Wow.
It does. That's right. So I don't think anyone. The thing is, I don't think people are really that serious about it. I mean, nobody really wants. Because I said the other thing I said is that if we really are serious about housing becoming more affordable, then residential real estate has to become a really bad investment for a long time. You can't, it has to not provide a return. So therefore, how can private capital do it? How can private capital that requires a return of somewhere between 8 and 10% per annum provide affordable housing? It can't.
Yeah.
I mean, private capital builds roads, right? They're expensive roads. They cost a fortune.
I guess it could do it with government subsidies, though, couldn't it, Alan? So one way or another, the state has to.
That's the point, yeah. I mean, and I reckon the government might as well just build the houses as they used to 50 years ago, but got crowded out. But the government's now trying to sort of get away with, we'll do a little bit because we haven't got much money, because we're spending too much on everything else. Now we've got to increase defence spending to 5% of GDP or something ridiculous.
Yes. It all makes the productivity roundtable very important, Alan. Have you got your invite yet?
No, it must have got lost. It's only 25 people, and it looks like he's issuing the invitations for it, but it's going to be, the head of peak councils, the head of the Business Council of Australia, the head of the Social Services organisation, all the sort of peak body heads. So
at least there won't be any barrow pushing in that room, hey?
Well, exactly. I mean, all these people, they've got a job to do, which is to push their constituents' members. It's fair enough. That's what they're supposed to do. But I don't know. I mean, I think that they shouldn't talk about tax reform because it'll just bog them down. No one will agree on anything. I mean, they won't agree on whether there should be tax reform, extra taxes, or lower taxes, or extra cuts in spending, and just go around in circles.
Yeah. No, I think you're right. It's going to be an interesting process.
Okay, well, let's move to questions. Before we do that, let's have a quick word from our sponsor.
Want to learn how to pick the best ETFs for your portfolio? Join Alistair Davidson and Tom Wilson for a free webinar where they'll reveal the 5 key metrics InvestSMART uses to select top-tier ETFs to build diversified portfolios. They'll also break down why ETFs are so popular, the difference between index and thematic options, and answer your questions live. Don't miss out. Register now for the session on Thursday, 10 July at 1 p.m. or sign up to get the recording sent to you later. Visit investsmart.com.au/events.
Okay, first question is from David. He says, a lot's been said recently about AI destroying employment prospects. In the corner of muddling through, is there a glass half full version whereby companies take the productivity benefits of AI, retrain staff to new roles, and actually achieve a whole lot more with the same or similar staffing levels? Would keeping a combination of staff and AI expand income and profitability and make companies more profitable? Perhaps this rose-coloured future will meet the Mike Tyson punch in the face of economic realism.
Yeah, I think David's right. I think that's exactly how people will start. They'll aim to use AI, keep similar staff levels, and then over time they'll discover that the AI is getting better and better, and they actually don't need as many staff, and they'll reduce the size of their workforce, perhaps through natural attrition to start with, and then perhaps more aggressively. But I guess I would just say, David, put yourself in the shoes of someone trying to break into that type of workforce. Where's the entry level job in that type of world? The AI is going to be doing the easiest tasks that would usually be given to the new worker. So how do you break into that workforce? I think it's still a pretty tough, natural attrition might mean we get a slower rise in unemployment through AI, but I think we'll get the rise anyway, won't we, Alan?
Yeah, I interviewed a bloke called Henry Badgery last week who has a consultancy, an AI consultancy, which helps companies, introduce AI. And he says there's 2 ways to do it. There's top down and bottom up. And companies are doing both of these things. Top down means where the executive leadership of the company decides to bring in AI company-wide in some way. And that invariably involves replacing workers because, they're making a decision to have their call centre done by AI so that the AI answers the phones, or they're having data entry done by AI and so on. So top-down means getting rid of workers. Bottom-up means what David's talking about, where workers become more productive themselves. And Henry says that the key to that side of it is writing the prompt. And so it's all about how you actually instruct the AI to do whatever it is that's required. And so what he's doing is setting up a prompt writing tool that helps people write prompts.
That's great.
Which is interesting. And he set up a prompt library. So I was suggesting that one of the things the Productivity Roundtable could do was to organise a national prompt writing assistant, something that would help all SMEs to do that instead of having to go to little consultants and just would say, this is how you write. This is how individual employees can better use AI.
Just imagine that, though, Alan. Say there's a team of 10 people in a small business. They're all doing that. They're all writing their own prompts. They're all getting, they all catch on to this craze. They all become super productive. How long till a boss figures out, 10 people, maybe we only need 7?
Yeah, of course. That's 5. Right.
So, I mean, it's just...
That's right.
Yeah, but I think there's different ways to get there, but we're going to get to the same place.
Yeah, so I reckon one of the keys to making AI used, and helping everyone become more productive is for the government to have a proper safety net. Because at the moment, the job seeker system for unemployment benefits is not fit for that. I mean, it requires you to have to apply for 4 jobs a month, and the money's not enough. I mean, it's sort of the job seeker system is built for a different time, a different setup. If what we're heading towards is permanent unemployment because of AI making companies more productive, then the government safety net needs to be different.
Yeah, no, well said. Keith says, with Northern European drought and the rise of AI and data centers that are extraordinarily thirsty, will water become the commodity that sees countries go to war in the 21st century? If Meta Platforms is prepared to pay $100 million for an AI engineer, what are they prepared to pay for water to cool their data centers?
Are data centers water cooled? I thought they were cooled by air conditioning driven by electricity.
They are pretty water hungry, and you do need a source of water. Yeah. There are improvements in the cooling area, but they are still pretty water hungry and more power hungry. But I think Keith's got a reasonable point broadly about the resources we're going to need to fuel these data centers. I wonder if that's the handbrake on AI in some ways.
Yeah. I mean, the electricity AI takes is enormous, so that's going to have a big impact.
Yeah. Not sure. Hopefully we're not going to war over it, though.
Kylie says, why wouldn't a simple, equitable tax system work in Australia? And what would happen if no financial engineering or deductions could be claimed and everyone was just taxed a flat 20% once on income? Yes, the old flat tax. Well,
flat tax.
Flat tax. No, I don't think so, Kylie.
Yeah, it could work, Kylie, but we're too far gone for that. Andrew says, love the podcast, and he agrees with Alan that wealth taxes will probably become more common, but he does have a question about inheritance taxes. The UK has an inheritance tax. The anecdotal feedback that Andrew gets is that the middle class pay the inheritance tax while wealthy Britons use trusts and other structures to avoid it. How would Alan propose to prevent tax avoidance on inheritance by the top income earners? It's a good point.
Yeah, well, wealthy people always avoid tax, I mean, tennis players all live on British Virgin Islands or Cook Islands or somewhere, Bahamas. They're all it's amazing. I think even Alex de Minaur lives in the Bahamas or somewhere, doesn't he?
Please. That's just surely just for convenience, I'm sure. I think Pat Rafter was a Bahamian for a while there as well.
Yeah, look, so it's true that when wealthy people avoid all sorts of taxes, including inheritance tax, of course, because they can.
Yeah.
I don't know. I mean, it depends where you put the threshold. Inheritance tax would have to have a threshold of some sort of thing where you pass on a couple of million and it wouldn't be taxed, but anything above that would be taxed, I suppose. I mean, I actually don't know what the threshold in the UK is. I'm sure you know, do you, James?
No, me neither, I confess. But I mean, it is a good point. You would have to, you would want to make this pretty tight to make sure everyone's captured if you're going to do it. You don't want it to be unequitable, as Andrew's suggesting.
Lachlan says, last week a listener asked why the government doesn't lower migration to help ease the demand side of the housing equation, and Stephen pointed out that high immigration is endorsed by the business lobby for labour supply, among other benefits, and high immigration improves our GDP. So the federal government loves it. I've always accepted this logic, but the obvious drawback is that this boost to GDP doesn't seem to trickle down to the states to spend on infrastructure improvements necessary to service the growing population. And he continues on, and Victorian government is too broke from all other infrastructure upgrades. It's poured money into into the past decade. So, yeah, I mean, that's right. That's the problem with migration, is that the federal government gets the benefit of migration in extra GDP, but the states have to pay for looking after them. That's true.
Yeah, and I guess that's why the debate or the fight about the GST distributions is so important to the states, isn't it, Alan?
Of course, that's right. And the states are desperately hungry for money usually, because they're having to build all the infrastructure to keep, because it's just becoming impossible to get around. The infrastructure these days is so expensive. I mean, so look, I think that this is a real problem. and the federal government. I mean, the federal government hasn't got a target for immigration. It's got a forecast that the Treasury publishes in the budget, and that's it in terms of numbers, right? So the Treasury forecast for the financial year just finished was 340,000. That's in the last year's budget. And in the first 9 months of that financial year, which is all we've got data for, the immigration, net overseas migration, was 400,000. So well over the whole year's target in the first 9 months. So that's been blown. And then there's the forecast, Treasury forecast for this current financial year that we've just started is 260,000. There's absolutely no way that's going to be met. So the immigration is out of control in the sense that they are not controlling it.
Yes. Yes, it's uncontrolled.
It is.
All right. Yeah. Jamie says, love the pod and looks forward to it every week. Great mix of wisdom and the occasional well-timed dad joke. Oh, I don't know if that's a backhanded compliment. Jamie bought into AFIC about 5 years ago. That's the Australian Foundation Investment Company, the largest and oldest listed investment company on the ASX. When it was, and he bought in 5 years ago when it was trading at a premium to its net tangible asset value. But looking at the long-term chart on their site, we're now seeing a roughly 12% discount to NTA as of the end of May. That's pretty extreme, possibly the biggest in 2 decades. So what gives? Has the shine worn off old licks like AFIC? Is it just the ETF revolution eating their lunch? Or are investors sending a message about AFIC's portfolio strategy, or just preferring the liquidity and transparency of newer structures? Keen to hear your take. Value opportunity or value trap?
What do you reckon?
Well, look, it is really interesting because I've charted both of these things. I remember talking to the AFIC team, a couple of years ago when, they were trading well above NTA, and it was a real problem for them. Why would you pay $1.20 for $1 worth of assets? Now they're, as Jamie says, sort of 88 cents for $1 worth of assets, which seems like a pretty good deal. But AFIC don't want that gap to be as big as it is. The question is why. I think money flowing into passive is part of the attraction. The AFIC team would say that it's at times when markets are particularly dislocated that and the big franking credit pools that they tend to have through their blue chip portfolio is particularly valued. We haven't really seen a period of market dislocation or an extended period, so perhaps that's part of it. But I think it's a lot to do with ETF passive flows at the moment, Alan.
I think so too, because AFIC is not that different to an ETF in the sense that they very much hug the index. Yeah. So I mean, people are kind of looking at AFIC, and then ETFs are cheaper and much more. The thing about AFIC is if what you want to do is match the market, which people who invest in AFIC are basically trying to do, you might as well go an ETF which matches the market exactly. Doesn't there's no risk that they're going to miss out on something, your ETF. Whereas AFIC, if it's making decisions, they've got as much chance of missing out on say CBA going up a lot as any as actually making wins.
Yeah, but that's also their strength, isn't it, Alan? Like, AFIC has been underweight the banks for some time on valuation grounds. So if you're in an ETF, you're blindly jumping into CBA at the most ridiculous valuation in the history of Australian banking.
Which has been a great decision.
A great decision, sure, but will it always be a great decision, I guess is the point. Do you want, and I'm not saying one's right or the other, but there is, I would have thought, some value in going with, or why you would go with the listed investment company is that they are looking at that and trying to be discerning about those sort of decisions. So there is a difference between the product, but I think you're right. Maybe people aren't seeing that difference or valuing it as they once did.
On the subject of banks, it was interesting that that yesterday Commonwealth Bank went down. What did it go down? I'm just having a look further. for it again. The Commonwealth Bank went down 1.2%, ANZ went up 2.5%, and all the banks went up while Commonwealth Bank went down.
Wow.
And I just wonder if that was the beginning. Is
this
this the beginning? Is this the start of CBA's reversal?
Oh, I hope we've got this on tape, because if it is, you're going to look like the sage of the ASX once again.
Here's someone who calls himself a boomer who cares about the future. I was appalled but not surprised that Alan got attacked over his very sensible suggestion of an inheritance tax. Do the people whinging about this and the proposed super changes not realise that they are receiving a tax concession? That is, they are being subsidised by other taxpayers. Probably their own children are subsidising them. Thank goodness the demographic change is coming to get these people, because change is coming. So this is a boomer who's talking about this, not a millennial. Anyway, what would be your top 3 tax changes? Yeah, well, I like Richard Holden's GST idea, I must say.
Yeah. Well, I can't really beat that for creativity. But I think some of the super tax concessions, and I'm not picking on SMSFs here, just to make that clear. I think some of that will be tweaked. In some ways, super is mature, and in some ways, it's still immature, and we're still working out, how it's going to develop and build and all that sort of thing. So I think there's some interesting. That's an area where there is the potential for reform, but it's going to be very, very dangerous politically, isn't it?
It is. That's right.
Trudy says, love the podcast, always equal parts caffeinated and clarifying. Here's one for you. Could part of the market's resistance to change be less about fundamentals and more about who's actually in the market these days? With the rise of retail investors, cheers, pandemic boredom and Robin Hood style apps, we've seen an influx of everyday folks driving into investing, many without a deep understanding of how markets actually work. Is it possible that this wave of economically undereducated optimism is helping fuel a self-fulfilling momentum? In other words, could the sheer belief that markets always recover be keeping them inflated until they don't? Curious to hear your take. Are we living in an age of the perpetually buoyant market powered by memes and misplaced confidence?
Oh, yeah, maybe. It's interesting, isn't it? I mean, it does feel like there's been structural changes to the way the market operates, versus what it used to. I mean, and I think ETFs, passive investing, is a big part of that.
Yeah, I think the investors, the professional quote unquote investors that I talk to, say the market's unrecognizable from a decade ago because you've got a lot more passive investing, you've got a lot more quant investing, you've got a lot more retail investing, as Trudy's alluding to. And then in Australia, you've got super fund flows, which are, so large and so dominant, they can sort of compound all of those things. So you've just got fewer active stock pickers in the market who are thinking deeply about fundamentals. And you've got more machines and people who are trying to keep riding the market's upward march. So I think that there is a change there, but it's it's a bit like when it's raining at the footy. It's the same for both sides, right? If that's the way the market's changed, is there an opportunity to keep riding that? It's it's just the new structure you've got to deal with in a way.
It was interesting because in the early days of the growth of ETFs, people were saying, "Oh, well, look, yes, it's kind of everyone's piling into them on the way up, but boy, wait till it starts falling, and it'll be leveraged in reverse. It'll be even worse on the way down." I don't think that's actually true. I mean, the market seems to not have big falls. It has a fall, but then it recovers rapidly. And I think that, I presume it's because people start saying, okay, well, I'm putting my money back into the ETFs again.
Yeah. Well, we've been, certainly retail investors are conditioned to buy any dip because it's working. It's worked so well for the last 3 years. So I think there is a sort of reflex, but eventually there'll be some sort of, there's always a black swan that disturbs that that we don't see coming from somewhere. And yeah, at the moment, put it like this. Commonwealth Bank's 12.4% of the ASX 200. If Commonwealth Bank had some sort of scandal or crisis and the shares started moving, that would have some really big implications for, the broader index. It just has to.
It's true, yeah.
Yeah.
Perhaps we should finish with Toby, who says he loves the Money Café, listening to your last episode in Cape Town before heading home to Singapore tomorrow. So we're a global podcast, mate.
Yeah,
One thing I wanted to point out is, having just read Robert Lustig's great book, Metabolical, if you take statins, you only live another 4 days longer than if you didn't take statins. Your final remark in the last episode suggests that statins are a contributor to us all living a long time, but maybe they're not.
Wow.
Okay, well, I haven't read this book, and I'm taking statins, and it's only going to be 4 days. Oh, well, we'll just have to make those 4 days really good ones.
If you did a Money Cafe podcast on all of those 4 days, how enjoyable would they be? That's just worth living for, I would assume.
Oh, yeah, that's right. I mean, this is living, no doubt about it.
Absolutely. Absolutely. Well said.
Okay, good to talk to you again, James.
Thanks for having me, Alan.
Thanks, everyone, for listening to today's episode of The Money Café. I'll be back next week with Stephen Main. Send in your questions to The Money Café at eurekareport.com.au. I'm sorry if your question didn't get read out today, but we get so many, we can't do it all. We try to pick the best ones. But until next week, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and a finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.